Okay, I want to start today with a little mental exercise. I want you to picture a number. Just write it down in your head. $188 billion. dollars.
It's a number that actually makes you stop scrolling, doesn't it?
It jumped right off the page at me this morning. We are looking at the Q4 2025 earnings report for Brookfield Corporation. That's ticker BN, which just dropped today, February 12th, 2026.
And that number, the 188 billion, that's not their total value.
No, not their market cap, not their debt load. That is their deployable capital.
Dry powder.
Exactly. Cash on the hip, ready to go.
To put that in perspective for you, I mean, $188 billion is larger than the entire market value of most companies in the S&P 500.
Yeah.
You could buy entire industries with that kind of money.
And Brookfield just has that sitting there, liquid, waiting for a deal.
Yeah.
And that really sets the stage for today's deep dive. It's early 2026. We're finally seeing interest rates start to tick down globally, the M&A market is. Well, it's waking up after a long nap.
A long hibernation. And here's this massive alternative asset manager sitting on a historic war chest.
And the mission for this deep dive isn't just to look at the spreadsheet.
No, we want to figure out the strategy. Because when you peel back the layers of this report, you see a company that is zigging while everyone else is zagging.
Doubling down on assets everyone said were dead like office space.
And betting the house on the actual physical backbone of the whole AI revolution.
Right. So we've gone through the earnings release, the letter to shareholders, and the conference call transcript to pull this all together. Let's start with the engine itself. They call it the compounding machine.
And looking at the headline numbers, that engine is running very hot.
It really is. They reported distributable earnings before realizations of $5.4 billion for the year, a record.
Okay, so let's unpack that term for a second, because finance loves its jargon. Distributable earnings.
Right. We're not just looking at standard net income here.
No, and that's a crucial distinction, because Brookfield owns so many real assets, hydroelectric dams, office towers, pipelines, standard net income gets incredibly messy.
They get all that depreciation.
Exactly. Depreciation, amortization, all these non-cash things that make the profit look smaller than it actually is.
Yeah.
Distributable earnings is basically the cash profit the business generated.
The money that actually hits the bank account.
That's it. And hitting $5.4 billion is significant. But the CEO, Bruce Flatt, he shared this statistic that, honestly, I had to read twice. He called it the miracle of compounding.
I saw this.
He said if you invested $1 million with Brookfield 30 years ago, today, that account would be sitting at $285 million.
That's just hard to process. $1 million to $285 million.
It's a 19% compound annual return for 3 decades. It's staggering.
Wow.
It really shows that time is the secret ingredient. But, and this is the big but, to stay in the game for 30 years, you need resilience. You have to survive the crashes.
Which brings us right back to that $188 billion number we started with. Why do they need that much cash? Is it just hoarding?
Far from it. It's what I'd call strategic aggression. I mean, in 2025 alone, they raised $112 billion from clients, financed another $175 billion, and sold $91 billion worth of assets.
The velocity is insane.
It is. But the reason deployable capital matters so much is that it lets them be the bank when the banks are closed.
So when the market panics, Brookfield goes shopping.
Precisely. Think about it. When a recession hits or liquidity dries up, most companies just freeze. They can't get a loan, their stock tanks, they go into survival mode.
Right.
Brookfield operates inversely. When everyone else is paralyzed, they don't need to ask for permission to do a deal. They have the checkbook. They can buy high-quality assets at a discount because they're often the only ones with cash.
It's the classic be greedy when others are fearful strategy, but like on a nation-state scale.
And that creates resilience. They're never a forced seller when the market's down, but they're always a potential buyer.
Speaking of buying things that people think are scary, we have to talk about real estate, specifically office space.
The elephant in the room.
For sure. If you've read a newspaper or a blog post in the last 3 years, the narrative is totally clear. Office is dead. Everyone's at home. Skyscrapers are ghost towns.
That is the narrative. It's what everyone knows to be true. But the data Brookfield just put out, it tells a completely different story.
They're almost aggressive about it. They wrote that sentiment is finally realigning with fundamentals, basically saying you were all wrong, we were right.
And they brought the receipts. Their super core and core plus portfolios, so their best, highest quality buildings, they're over 95% occupied.
95% occupied in 2025? I mean, that sounds impossibly high.
It is high. But here's the nuance the headlines miss. It's a bifurcated market. That old, dark 1980s office building in the suburbs with bad AC,
Yeah, that's probably dead.
that's a zombie asset.
Yeah.
But the trophy assets, they're better than fine. It's a flight to quality.
So people are still leasing.
Brookfield signed leases for 17 million square feet globally last year. But here's the aha moment. They are paying significantly more to stay. In New York, they signed 2.4 million square feet of leases. Any guess on how much the rents went up compared to the old ones?
I saw this. It was 20% higher.
20% higher on renewal. In Canada, it was plus 10%. London, about 10%. These aren't distressed assets.
So wait, if the headlines are all about a crash, but Brookfield is raising rents by that much, the disconnect has to be supply, doesn't it?
Exactly right. It's basic economics. Because interest rates were so high and the sentiment was so terrible, nobody built new office towers. Construction just ground to a halt.
So there's a shortage of the really good stuff.
A massive shortage. There's very little new high-quality supply coming online this year or next. So if you're a big company like Moody's or Visa, who both just moved into Brookfield properties,
Yeah.
and you want a premium headquarters.
You have very few options, and you have to put your employees in a palace, not a dungeon, if you want them to come back.
Right. And since no new palaces are being built, the price of the existing ones just goes up.
And Wall Street seems to be waking up to this. There was a detail in the report about a financing deal for a downtown New York office property. It was 10 times oversubscribed.
That is such a critical signal. Oversubscribed means for every dollar they needed, lenders offered $10.
That's wild.
Banks, insurance companies, they're fighting to lend money to these assets. That tells you the so-called crisis is over for high-end real estate. The smart money is already back in.
Okay, so real estate is the contrarian bet that seems to be paying off. But there was another massive piece of news in this report, a corporate restructuring.
Yes, the merger of BN and BNT.
Let's break this down. BNN is the parent corporation we're talking about. BNT was their insurance affiliate that they spun off, and now they're putting them back together.
That's the plan. They intend to merge them within the next 12 months.
I have to ask, why the flip-flop? They spun it out to highlight its value, now they're reeling it back in.
Well, it's actually a sign of its success and an evolution of the strategy. Spinning it out as BNT helped the market see it as a real standalone business. But now, it's grown so big assets hit $145 billion that keeping it separate is actually becoming a hindrance.
A hindrance how?
Two main reasons. First is technical. Index investing. The current split structure is suboptimal for getting into the big stock indices.
Ah, the passive flow game. If you aren't in the index, the big funds don't buy you.
Exactly. Merging creates a single, larger, cleaner security that's easier for passive funds to own. But the second reason is much more fundamental. It's about capital firepower.
It's a balance sheet.
Right. The insurance business, they call it wealth solutions, is growing incredibly fast. And insurance is a capital-intensive game.
You need money to back up the policies.
Yes. By merging, that insurance arm is no longer just relying on its own balance sheet. It gets the direct backing of the entire $180 billion capital base of the parent company.
So it's like giving the insurance division a limitless credit card.
In a way, yeah. It lets the insurance business take on bigger deals and grow faster without needing to hold as much dead capital just for regulatory safety. It makes the whole thing incredibly capital efficient.
And speaking of that insurance business wealth solutions, it really seems to be the engine of the whole company now. You said $145 billion in assets. They're targeting $200 billion by the end of this year.
It's explosive. And if you want to understand Brookfield today, you have to understand the magic word, float.
Ah, the Warren Buffett playbook.
Exactly the Buffett playbook, but adapted for this era. It's simple. You take on insurance liabilities, like pensions. You promise to pay people later. In the meantime, you hold on to their cash. That's the float.
And you get to invest it for yourself.
Correct. But here's the kicker. According to the report, their protection business generated $8 billion of float at virtually no cost of funding.
That is the wild part. $8 billion that they can invest, and it costs them nothing.
Virtually nothing. I mean, a bank has to pay you interest on your savings account to get your money. That's their cost. Brookfield is getting this money at 0%. If you can borrow at zero and invest it in infrastructure earning, say, 12%.
That's how you build an empire. It's free leverage.
It is. And they're finding this money all over the world. They mentioned big moves in the UK and Japan.
Let's touch on the UK deal. They're acquiring the Just Group. Why the UK?
This is the pension risk transfer market. Basically, UK companies have these huge pension obligations on their books, and they don't want to manage them anymore. They want to offload the risk.
So they pay Brookfield to take the headache away.
Yes, there's £50 billion coming to market in the UK just in 2026. Brookfield takes the liability, but they also get the massive pile of cash that comes with it.
And they think they can invest that cash better than the pension fund could.
That's the bet.
Huh.
And then there's Japan, a $3 trillion savings market with a rapidly aging population, all desperate for yield because their interest rates have been near zero forever.
A perfect match. Japanese savers need yield. Brookfield has the real assets, the dams, the power lines to generate that yield.
It's a self-reinforcing ecosystem. The insurance arm provides the fuel, and the asset management arm builds the engine, which leads us to where they're putting all this capital.
The future themes: AI, power, and infrastructure. This was the part of the report that felt the most sci-fi, but it's actually very grounded. They talked about partnerships with NVIDIA and Microsoft.
It's all about the physical constraints of AI. Everyone's focused on the chips or the software, but we're hitting a physical wall. AI needs massive data centers.
And those data centers need massive amounts of power. They called it the AI grid supercycle.
A great term. And Brookfield is uniquely positioned here because they own the power generation. You can't just plug a gigawatt data center into the wall. You need dedicated power.
They mentioned a partnership with the U.S. government to accelerate nuclear power.
It's a long-term play, but it's necessary for baseload power, power that's on 24/7. And they have a partnership with Google for hydroelectric power.
So it all connects back. You can't have a digital economy without the physical stuff to power it.
Exactly. You think of AI as this intangible cloud thing, but Brookfield is saying, no, it's concrete and copper wires and uranium, and that's where the moat is. Anyone can write code. Not anyone can build a hydroelectric dam.
Okay, so we've got the compounding machine, the contrarian real estate bet, the insurance money engine, and the AI power grid. Let's look at the scorecard. How did they treat shareholders?
Very well. They raised the dividend 17%. That's a healthy increase. But the bigger signal, for me, was the buybacks.
They bought back over $1 billion of their own stock.
At an average price of $36. And this is the key takeaway. Management stated explicitly that they view that $36 price as a 50% discount to intrinsic value.
Wait, hold on. They think the stock is worth double what they paid for it.
That is what they are saying. And remember, these are the insiders. They know the value of every single building, every pipeline. When they're buying back stock that aggressively and telling you it's 50 cents on the dollar,
that is a massive vote of confidence. They aren't just telling us the assets are valuable. They are buying them back from the public because they think the market is wrong.
Exactly. They do a sum of the parts valuation. They look at their Wealth Solutions equity alone and value it at something like $28 billion. When you add everything up, the public market price just doesn't match their internal math.
So let's wrap this up. If you had to summarize the state of Brookfield in early 2026, what's the takeaway for everyone listening?
Well, I see three pillars. First, real estate fundamentals for the good stuff are much stronger than the headlines. The office is dead narrative is officially dead for trophy assets.
Okay.
Second, the insurance business has transformed. It's a massive low-cost funding source that fuels everything else. It's the engine room.
And third,
they're simplifying. Merging BN and BNT supercharges that growth and just makes a whole company easier to understand and own.
So what, for the listener, is really about following the smart money.
It is. It's about seeing where capital is moving before the rest of the world catches on. It's moving into scarce, real assets buildings, power grids. Because in a digital age, the physical backbone becomes more valuable, not less.
The physical backbone of a digital world. I like that.
And I'll leave you with this final thought.
Yeah.
We talked about those buybacks. Brookfield is one of the most sophisticated asset managers on the planet. They see every deal in the world. And yet, the deal they seem most excited about is their own stock.
Because they think it's 50% off.
Right. So the question for everyone listening is, if the people who own the infrastructure of the future think it's worth double today's price, what is the public market missing? Are we underestimating the cost of rebuilding the world for AI? Because Brookfield is betting billions that we are.
That is definitely something to chew on. Thanks for diving in with us today.
My pleasure.
Catch you next time on The Deep Dive.